I'm delighted to announce Enter the Boardroom now has its first sponsor, Alt21, the foreign exchange and hedging platform saving you time and money on your cross-border transactions. As an investor, I was acutely aware of the value of hedging FX exposure. I used to live in fear of funding shortfalls at a closing or making a loss in a business having forecast a profit. However, as a CEO, I'm embarrassed to say I have dropped the ball on FX. Because we invoice our revenue in pound sterling, I stupidly thought we had minimal FX exposure. After speaking with Alt21, I realized a significant proportion of our software costs are in US dollars. So we have wasted money on FX fees and wide spreads, while also taking on unnecessary risk in our budgeting because we assumed the spot rate would continue through the year. I can't be the only one to have slipped up on this, and it's an area board members can quickly add value with the right questions. Alt21 allows you to lock in fixed fees and secure exchange rates before any cross-border transaction, allowing you to budget with certainty and protect your business from market volatility. At NewRoll, we're now forecasting savings of 90% on the fees we incur on the tens of thousands of monthly FX spend thanks to Alt21. Head to alt21.com, that's alt21.com to find out more. Hello and welcome to Enter the Boardroom with NewRoll. I'm your host, Oliver Cummings, CEO of NewRoll, the board search specialist and market leader bringing science to the art of board hiring. Today's guest, Nick Jenkins, is founder and former CEO of online greeting card retailer Moonpig, which he took from 0 to 45 million revenues in its journey to a £1.5 billion publicly listed market cap. Nick is chair of Virtualstock, Europe's largest dropshipping SaaS platform, NED at Green Energy Options, and trustee at Operation Fistula. He's a former Dragon on BBC Two's Dragon's Den. Nick, a huge welcome and thank you so much for joining us today.
Thank you for inviting me.
Nick, I really enjoyed preparing for this discussion. It was an education watching the various bits that are out there on you where you've shared your wisdom. You've been through the full founder journey of launching, scaling, and successfully exiting. And one of the things that you talked about in some of the pieces you've done in the past was that initial 2000 to 2005 period before the business took off, which you've highlighted as the most difficult part of your journey as a founder. Can you briefly paint that picture? And in particular, I'm really interested to hear about the key sources of support and challenge that you had through that period.
I set the business up as a sole founder. And that was something that when I was doing my MBA, when I stopped work, I did an MBA for a year while I worked on a variety of different cunning plans. And one of the messages that I got very clearly from a lot of the entrepreneurs that came to talk to us at Cranfield was the importance of deciding whether you want to be a sole founder or you want to share it with someone else. And very often what happens, people are discussing an idea in a pub and there are three of you and you're chatting away and someone has a bright idea and you'll get chatting, hey, why don't we all do this? And immediately you've given away 66% of your equity on day one. So I thought I'd started out, I had a little bit of cash left over from Russia. I thought I'd start out on my own and I thought I would bring in the support that you might otherwise need from co-founders in the form of investor directors. And I would make that distinction between an investor director and a non-exec direct. An investor director is someone who's they've stuck some of their own money in, and you invite them on the board for their expertise. But also from their perspective, they're following up on their own investment. So that was when I started. It was very much I was a sole founder, but I fairly rapidly within a year or two had 3 or 4 investor directors on board to bounce ideas off. And it was the first 5 years was a bit tricky, and I had a very clear idea of what the company was going to do, but no idea how quickly it was going to take off. I think I probably underestimated how difficult it was to get customers in those early years. The product was very popular. People loved the product, but it was just quite difficult to recruit new customers. And so the first 5 years, we were constantly having to raise more money to keep feeding the losses until eventually we broke even. And then the numbers were going in the right direction. I could see the numbers were going in the right direction, but it's a little bit harder sometimes to persuade my own shareholders and investors to carry on with it. And there were points where all of my shareholders actually just said, enough's enough. We can't put any more money into this. It'll never break even. And so it was a bit of a journey.
How did you pick those first investor directors?
I'd like to think that I picked them, that I selected them, but it was more that I had quite a few investors. I think we had about 14 investors early on, and some of them expressed an interest in becoming a director, sitting on the board. So one of them, Tom Chandos, who was a wonderful non-exec director, he represented a group of investors. So that made perfect sense. To some extent, he was more like the proper non-exec director because he was representing the interests of a whole load of others. But then I had David Noble, who was a friend of mine who'd put money in, and they were the first two. And then after that, Duncan Spence, who came on board as an investor, who was invaluable, actually, because he came from the greeting card business and he brought a lot of experience from there. And Lorne Dogood, Lorne Dogood came before Duncan, and Lorne came from the business. He came from the greeting card business, and as a result, he brought in Duncan. So there was a reason behind everyone, and every one of them there was no Deb Wood in there, thankfully. Everybody, they all came up with some crazy ideas too, but every single one of them came up with something that probably saved us from bankruptcy.
So you have talked in the past about the light bulb moment you had around pricing when one of your NEDs, I think it was David Noble, asked why you weren't increasing the price from $199 to $299 when you were fixated on low costs. And I think you mentioned another of your NEDs helped bring in a major investor. What was the value each of the others brought? Because I think you said all of them brought something.
Yeah, so Tom consistently brought along his other shareholders and they followed on with rounds when it was necessary. That probably kept us going for the first couple of years. Then David came up with the odd gem of wisdom. Now, the pricing was an interesting one. Price is a big mistake most people make. They just get transfixed on a price point. And David was the one who, in the best possible role of a non-exec, standing back from it, said, why don't we just put the price up? And I think that is a really important role of non-execs, is to ask those questions. If you can answer that question, that's great. But if you can't answer the question, then let's have a discussion about it. And the answer was I couldn't. He asked the question. I thought, I don't know. Why not put it up to $299? And we all agreed that if we put it up to $299, if we got it wrong, we would go bust, but we were going to go bust anyway. And if we were right about it, we'd be fine, because it massively increased the amount of margin by it trebled the amount of margin we were making. And we tried it, and lo and behold, the customers didn't react at all, didn't mind, because actually £2.99 was perfectly good value for what we were offering.
You talked about the moment when all your shareholders, effectively your investor directors, I guess, turned around and said, this isn't going to work. That must have been a terrifying moment. Where did you source your support from at that point in time to keep yourself going?
My conviction came from the numbers, because I'd always measured the numbers very methodically, and I could see that we were growing organically without really spending any money on marketing. We were growing. When I think back, we'd actually run out of cash, and sales grew by 30% in a year when we spent nothing on marketing. Now I look back on that and think that's amazing, because so many other businesses I've been involved in, if you turn the marketing off, everything just stops straight away. So that gave me the conviction that if only we could continue to fund decreasing losses until we would eventually break even. And that's what happened in the end. So my conviction came from the numbers, and the financial support came from another external investor who came on board at the last moment. And the idea, but he was fresh. Every once in a while you need some fresh investors. And I've seen this many times. Your own investors have been battered and beaten by business plan after business plan that didn't quite work out as planned. And then sometimes you speak to somebody fresh and they think, yeah, it's wonderful. That's how we got around that.
So when you're talking with founders now, I mean, I guess you must come across a lot of founders who say, oh, my board is a nightmare. What do you think they're typically missing that you had unlocked with yours?
Well, sometimes they say the board's a nightmare. It might be they're a nightmare. So that's something I look back and I certainly had my fair share of ding-dongs with my non-execs. And with the benefit of having been an investor, maybe they had a point. I had promised quite a lot over the years, and it took us much longer to deliver on that. So it wasn't, at one point, I think one of the investors suggested that I move on and we find a new CEO. And thankfully he'd misread the articles and thought he had slightly more power than he did. But whereas I paid quite a lot of attention to the articles, so I knew exactly where I stood. And I pushed on. But having said that, I did also recognize when it was time for me to move on. I think a good founder should be able to recognize when it's time to jump, not wait to be pushed.
Well, let's talk about that in a second. Before we do it, what was the biggest ding-dong that you had?
The biggest ding-dong was when one of my major investors and shareholders tried to remove me from the board. That's a fairly big ding-dong.
And You said you look back at some of the ding-dongs you had and feel like maybe they had a point. Which were those?
I think in that case, he was wrong. It wasn't the right decision was for me to stay, and I stayed and handed over probably about 2 or 3 years later. But I don't blame him for that, because I've been in a situation where I feel the founder is, as an investor, or as a board member, where I feel as though the founder is just getting too blinkered or a bit jaded, a bit exhausted. It's an exhausting process to start a business and keep it going, and to keep the momentum going is really quite difficult. So I don't think it's a perfectly reasonable thing to raise at a board. And some founders can also be quite tricky.
Talk me through that journey where you transition from founder, CEO to exec chair, because I've seen so many founders struggle with that. What can a founder or board member listening to this, looking to help someone go through that journey, learn from your experience?
In my experience, I hired somebody who had approached me. In fact, he'd approached me when we were still losing money. And he said, I want to come and work for Moonpig. He had experience in the greetings industry. He had experience at M&S. He had some good blue chip experience. Hadn't got any experience as a CEO. But I brought him in and said, I'll bring you in as a commercial director, and I will hand over the different bits of the business. And over time, I handed bits of the business over to him. He managed them very well. This is Ian Martin. And then I felt very comfortable with handing complete control over to him. But it wasn't a big surprise. So there are 2 ways of doing it. You can take someone and hand over bit by bit and see if they're the right person, and then hand it to them. But for that, you probably have to hire someone who's not been a CEO before, and this is their first CEO role. So it depends very much on the size of the company that you are. And we were quite small at the time, really. It was a reasonable risk to take, but also it wasn't that much of a risk, because by the time we took the decision for him to become the CEO, we knew who he was. We'd worked with him for over 1.5 years. There were going to be no surprises. And if you take the other approach, which is that you hire somebody and on day one, that's it, they're taking over, there is a tendency to want to take things apart and put them back together again and do it in their own image. And that can be catastrophic. It can be very good, but it can be catastrophic. And sometimes the temptation to dismantle things that are working perfectly well, and only discover afterwards why that had worked before. So I took the least risky option. I hired someone and brought them in, trained them up, and then took the decision to hand over control once I knew what we were dealing with.
And can you talk me through how exactly do you do that? Because that can sometimes be very difficult, especially with founders where naturally oriented towards being in control and looking over people's shoulders. Did you have a particular strategy for making sure they had enough space to grow?
Very definitely. And what I did, when I finally handed over, I went away for 3 months. I took 3 months off, went traveling, and said, that's it. You're in control. Don't call me unless there's a total disaster, but you're in control. And that was a good way of making him realize that actually I'm not going to look over his shoulder and correct things. And there were also quite a lot of points where he wanted to do things that I wouldn't have done myself. But I think I've given him control, so let's go with his judgment. So, for example, flowers. Ian wanted to start introducing flowers into the business, and I didn't think that flowers were particularly Moonpiggy. I thought they'd go well with the car, but you couldn't personalize the flowers, so I didn't think they were particularly Moonpiggy. I was wrong, actually. And Moonpig is now one of the biggest online florists in the UK. That was a good example of where I gave him the benefit of the doubt, didn't necessarily agree with it, and he was right.
And what was the role you brought Ian into that gave him that balance of independence while still being something you could keep an eye on?
We had a very clear understanding that I became executive chairman, so I would deal with external investors, and I would deal with the sale process, because we decided by that point that we were going to sell, and overall strategy. And we also agreed that I wouldn't talk over his head to staff. So if I had any concerns, I'd take them to him and say, I think you should deal with that. So we have very clear lines of communication, and it worked very well.
You once memorably said, the more I can help a business, the less likely they are to succeed. Really interested to hear how you think about the value you add as a board member today.
Well, what I mean by that is that if I come into a business that's run by complete idiots who have no idea how to run a business, and I think, oh gosh, I could teach you how to tie your shoelaces, I could teach you how to do this, I could teach you how to breathe, then clearly if they haven't grasped those basic concepts, they're in trouble. So I prefer to walk into a business where I'm deeply impressed by the founders, who I look at and think, gosh, I could learn something from these guys rather than the other way around. Naturally, the ones where they've already got it covered are the ones that are more likely to succeed. Whereas the other ones, it's very flattering to realize how much value you can add, but what that also exposes is how little they know. And that was my point.
You've talked about the challenge of scaling culture, that it's easy to build a great culture when you're a small organization, but as things start to grow, that doesn't always scale. For a founder, CEO, or a board member listening to this who's facing that challenge, anything that you've understood now and have in your playbook when you're facing that challenge?
I suppose the first thing is you have this super efficiency of a startup when the founder is on top of everything. and all money is treated like your own money. And then you have to accept there comes a certain point where in order for the business to grow, you have to delegate certain things, and things will be done less efficiently. And also, when the business reaches a certain size, you do need to have some procedures in place to make sure that everything is done properly, so that if one person walks away, it doesn't pull the business down. A good example would be that we had an IT team of 2 when, by the point Moonpig had started to get quite big. We had Jay, who was our IT director, and most of the code was in his head. I don't think he was very quick and efficient because he was incredibly bright, but he saved an awful lot of time by never writing anything down. And that was fine as long as he was alive, but it would, in a large company, you wouldn't allow that to happen, because if Jay had gone off to somewhere else or fallen under a bus, we'd have been in a real pickle. So you get those kind of the early stages of business. You're throwing things together and you're able to just take very quick decisions. And that's super efficient, but it's also a bit dangerous. And you can't sustain that very long. And you just have to accept that, and when you introduce another level of management into a company, you're going to get a lot of friction with that. So you're then trying to talk through 2 layers to get your ideas out into the workforce. I bet you can't grow without it. So you just have to accept that there's some inefficiencies that come in with size. It's the inefficiency of scale.
One of the things that's really helped me as she was implementing the traction AOS model has helped me cascade culture through the organization and through passes of my direct reports into their reports and into the reports below. Are there any kind of processes you've used or you encourage founders CEOs to look at when they're wrestling with that problem? What is the answer?
I think when it comes to culture, it always comes from the top of an organization. It doesn't come from HR. HR doesn't decide that this is how we're going to. Lots of people within HR will say, oh, we need a corporate culture, we need a mission, we need this and that. Those things should start at the very top, because the culture of a company, ultimately, people look at the person at the top it reflects the values of the person at the top. So if the person at the top is the kind of person who shouts and screams and throws chairs around at people, then don't expect there to be any respect when HR come up with a statement about respecting other people. It's as simple as that. You have to live and breathe the culture that you would like your company to have. If you are an obnoxious person, you're probably going to struggle with that. But I wasn't particularly formulaic about it. It's just that I thought I want a company to represent my values. I know what my values are, and I know how I like to be treated. I know how I like to treat other people, and I would make sure that's the way that everyone behaved. And I would occasionally pick up on managers coming in who were being a bit vicious or a bit abrasive, and take them aside and say, it's just not the way that we do things here. Fundamentally, also, we're a business that was trying to bring a smile to people's faces every day. And that's quite difficult if your own people aren't smiling. The culture was very important for what we did.
Know thyself. So I guess it sounds like it's those little micro interactions, things that you used to spread and to set the precedent there and make sure that what you valued was being valued around the organization. Data clearly played a big role in your Moonpig success, and in all the stuff that I've heard you speaking at, you're obviously very good with data and pay a lot of attention. But it's easy, I think, for startups and scale-ups to get lost in a sea of data, and board members too. What's your approach today now as a board member for making sure that your organizations are making good use of data?
One of my great rules in business is keep things as simple as you possibly can for as long as you possibly can. And if you look at any business, you think, what are the most important things that we need to know? And let's focus on those, and let's find out the right way of measuring them, and let's focus on those metrics. Any B2C business is going to be quite data-driven, because you've got an enormous amount of data. We have 5 million customers that were buying from us. And so we could measure their patterns of buying. We could see what they were doing. We could see what they were doing in the site in a way that it's quite difficult to do in a shop. If someone walks into a shop, you can do it these days, actually, with cameras and so on. But understanding, well, what do they go to first, and where do they go after that, and why did they go away? And understanding that was quite important. But the financial model was a fairly mathematical model that said, if we recruit this many customers, we know that of 100 customers that we recruit, we will have 60 of them will come back the next time. Of those 60, once they've decided to come back and buy again, then most of them will stay, and will stay for a very long time. And with the confidence that came from, and that would tell us how much we could afford to spend to acquire a customer, confident that we would get our money back in 3 months, 6 months, 9 months, whatever. And so I never talked about lifetime value. I find lifetime value a very nebulous term. How long is a life? Whereas payback time, if you spend money on marketing, when do you get that gross margin back? Is it 3 months, 2 months, straight away, first order, or do you have to wait 3 months, 6 months? That's a much more informative metric because it tells you, if I invest money in driving growth, how quickly am I going to get that money back so that I can then recycle it? Really important metric. But yeah, I think maths is quite important. And I always think it's a lot easier to teach a mathematician how to do marketing than a marketing person how to do maths. Some people are just not very numerical.
You, I think, identified repeat rate as the key metric for Moonpig, and I've always been fascinated by the concept of sort of North Star metrics. How did you get the confidence that that was your guiding star?
I suppose a bit of gut instinct, really. You can put together a jazzy campaign to persuade people to buy something once, but the second time they buy, they will have bought it in the knowledge of they know the product, they've tried it, and then they came back. And that, for me, is the most important indication of where your business is going. And it also it tells you so much about, it enables you to predict what's going to happen. If you spend this much money on acquiring customers, how much money, what's that going to do to your bottom line?
Have you found that you've always been able to identify that North Star metrics in all the businesses you've been involved with, or are there some that just don't lend themselves to that singularity?
Moonpig was very straightforward because we had 5 million customers, and that's a lot. That's a huge amount of data. So if I picked 1 million customers at random, they would behave in a very similar way to another 1 million customers. So on average, they'd probably look exactly the same. On the other hand, I've been involved in B2B businesses where the business is much more lumpy and you might have 8 or 9 major clients. And so it's much more lumpy. So that the metrics I would look for in a B2B business would be the churn rate. So one metric would be how much business are you winning? So if you make 5 pitches for every pitch that you win, that tells you something about the size of your market. The starting point, actually, this happened to me when I became the chairman of Virtualstock, and I hadn't had experience of B2B. So I was a bit reticent about taking it on, but then I sat back and thought about it. Well, the first starting point is let's have a think. All of our customers are very big companies. So we can quite easily identify how many companies are there in the UK that we could possibly deal with. So just download a list of all the companies in the UK from Companies House and have a look at them all and think, well, could we possibly do something with them? So that gives you a list of a few. Then you narrow down to those sectors that you can narrow that down to a list of companies that you would like to speak to at some point. And then so how many of these have we spoken to? So as a metric, I want to understand, okay, but how many of the possible universe of companies we could speak to have we spoken to? And then of the ones that we've spoken to, how many did we manage to persuade to listen to our pitch? And of those pitches, how many did we win? And that funnel then starts to tell you something about if every single company that could use our software used it, then our market will be this big. But in reality, what our experience is that based on the success of our pitches, it's much likely to be a fraction of that. So those are the kind of metrics that I would look at in a B2B. So it depends, but it's all basic common sense. And I think if there's one thing I learned from my MBA course is that business is mostly common sense and dressed up into something more complicated using jargon. And if you understand the jargon, you can peel away those layers and realize that really a lot of it's just common sense.
Talked a little bit earlier about your board members feeling jaded at the number of business plans that they had seen that had not come to fruition. How do you now, as a board member, look at business plans and how much weight do you put on them?
I would much rather see a business plan I put more emphasis on accuracy than I do on impressive looking numbers. And the same with a business pitch. When someone comes to me with a business plan, I would much rather that they show me, I would much rather believe that they've done some really accurate research and that the business has got a total addressable market of 120 million than them come back to me with a plan that says that it's a total addressable market of 3 billion when it's not 3 billion. They just haven't really narrowed it down. So to me, a business plan is an indication of how their mind is working. And if it's sloppy, then I'll take that into account. So there was 2 types of business plans. One is the one for raising money, and then the other one, which is how do we run our business. And with it, as a board, I quite like to start a year with, we're going to review our business plan and make sure we've got a business plan for 2025. And that's really just a question of taking down the one from last year and saying, has anything changed? And then updating it, bringing it up to speed, and then having a budget. So you've got a business plan and a budget. And as a board, if the executive is operating within the business plan and within the budget, then they should be free to just crack on with it and get it done. You should bring it to the board. What you should bring to the board is any exceptions to the business plan of, we've decided to change this, or we're not going to hit that, or we need more money, or whatever. But it's really helpful if you've got a business plan and a budget. So this is what we plan to do this year. But it also makes it much easier to hold the executive to account. And most people have a budget, of course, but not a lot of people have a business plan that they write with it. So it makes it much easier. So you said at the beginning of the year that this is what you were going to do, and actually you've gone off at a tangent why. But it's a helpful exercise. And also, every year, I think you just need to refresh your business plan and say, is it still on track? Does it still make sense?
When you talk about differentiating the budget and the business plan, are you referring to a sort of 5-year plan as the business plan, or what's the difference between the budget?
Well, generally speaking, I think your business plan should look forward accurately about 3 years, and then it should have a bigger picture. What's the bigger picture? Where could this go in the longer term? That doesn't have to be fleshed out in terms of numbers. But what I want to understand, as far as the bigger numbers go, I want to understand what's the size of the total addressable market and how much of that do you think we can capture? And it's difficult to say how long that will take or how you'll do that, but that's definitely worth doing.
When you took your business plans as a founder to your board, my guess is you thought through them hard, and yet you're saying that you had to keep revising them and weren't hitting them. When you're faced with that situation as a board member, one of the things I found now, having switched from being an investor to an operator, is I don't think I can predict much further than 6 months out, maybe 12, a really real stretch, and it's getting easier now as the business scales, it becomes more predictable. And so I sort of think now much more of the sort of the business plans as a scaffolding to understand the thought process rather than anything I'm putting too much weight on, because I know that once it hits reality, all sorts of things can happen. How do you think about that?
Yeah, I think, and the younger the business is, the more that's the case, because those early years are very unpredictable. It becomes more predictable over time. So accuracy, I think, is important. And so I'd take great story. If a board, if the executive have put forward a budget and it's uninspiring, but they hit it, at least they know what they're talking about. Because there's often this, we've got to have a stretch target. We've got to keep pushing ourselves. But there's no point in pushing ourselves if every year you consistently miss it, because it also makes it very difficult to incentivize people if they know that every year they've been told to stretch and they stretch but didn't quite make it and didn't get a bonus, and you have to rewrite the rules of how people get bonuses. So it's being realistic is quite important.
William Reeve, the founder of Love Film, once said to me, the board should be the CEO's highest return on time invested in any given period, which I found a really helpful guide. He said, if it's not, something's wrong. If I had the CEOs of the boards on the call now and asked them, is your board the highest return on time invested in any given period? What will they say?
Well, quite a few of them. So I would say that if I look back at the last board meeting I had, what's quite important sometimes is that you bring people together for 2 hours, and if you allow enough time for free conversation by not wasting time on long presentations of documents that have already been, so I see no point in preparing a presentation for the board and then talking through it line by line. I've already read it. So what I want within those 2 hours is I want to make sure that the directors have all read it and understood it and thought about it. And I want them to come in with challenges and questions and try to provoke something that think, wow, gosh, did not think of that before, and come away from it with a slightly different perspective on the business. And that's a really good return on a 2-hour meeting. What's a poor return on a 2-hour meeting is, and I've attended lots of those, is where there is an agenda that is packed with presentations and there just isn't enough room to question anything. And it's at the end of it, do we all agree? Yes. Now, if you want to run it as a dictator, that's fine, but you're not going to get the benefit. There's no point in having non-execs if you're not going to give them the chance to come up with the odd gem or to question, to probe. In a board meeting, I want to try and get as much debate as possible and new ideas and fresh insight, and use the fact that you've got 5 sets of fresh eyeballs on the issue to come up with something, to come up with something new. No, you might not, but you only need one of those great, for example, the board meeting where we decided to increase the price. That was the single biggest return on investment of that meeting. And then the one where Duncan Spence said, let's not only have humorous cards, why don't we have some non-humorous cards? Because not everyone wants a humorous card. Again, I got slightly transfixed on the idea that it was all about personalized cartoons. And we did that. That probably added 40% to our turnover. So those are the pearls of wisdom that come out in board meetings, if you allow that kind of discussion. But you've got to create room for it in a board.
And I suppose probably patience as well. It's not reasonable to expect penny drop moments like that to be happening every board meet, but over a period of 12 months, you should be expecting them to be dropping out.
But you only need one a year to make a real difference. But if you have quarterly board meetings, there's only 8 hours. That's only 8. And if you have one of those amazing moments for 8 hours of your life in a year, that's one working day out of 200. That's pretty helpful.
One of the things I really enjoyed researching this was your insights into industrial espionage. You talked about that penny drop moment where you saw one of your competitors spending money on TV adverts and they subsequently went bust. And I think most people would have seen that and gone, well, spending money on TV adverts was clearly a stupid decision, that they've gone bust. But you had been tracking their order numbers and had worked out their cost of acquisition of each of those customers as, I think, £10 per customer. Are there any other hacks like that you use now as a board member, an investor, to help your businesses spot opportunities that most others wouldn't?
There are lots of sources of information about your market, your competitors, speaking to your competitors' customers. We're all human. People like to talk. And so listening to your potential customers talking about why they enjoy using your competitor's product is helpful. So I think there's quite a lot that can be done to develop a picture of the market outside. That knowledge of what's going on outside your own company is quite important. What are competitors doing? And what do the public think about your product versus other people's products? All of that is really important and pretty easy information to gather. But a lot of companies don't. They're so focused on firefighting internally that they don't do that.
I just love the idea that you're out there buying these cards at regular intervals to track the order numbers. I mean, is that something that you do across most of your companies, buy regularly as a customer from?
Depends on the but in this particular case, because all of our competitors were like us, having very high volumes of small value items, it was, and also quite predictable because we knew roughly what their average basket size was. It'd be more difficult to do that with, say, typical Amazon buyers because we don't know what the average basket size is. We might not necessarily know what the average basket size is. But with that, we knew that they were buying a card and maybe two, but probably one. So in our case, it made a lot of sense to do that.
You also shared one of your key lessons as an investor director, which I think you got from one of your fellow dragons, Deborah Meaden, who highlighted the pressure that a business selling into the supermarkets would experience on their gross margins as they scaled, somewhat counterintuitively, that actually gross margins would go down as they scaled, as the supermarkets started to put price pressure.
Largely, and I hadn't realized this before I went on Dragon's Den, that supermarkets need a bit of variety on their shelves. They need innovative, new, independent, funky little brands on their shelves to make their shelves look more interesting. And it makes their shelves look fresh. And there's a reason to come back. It's not just the same stuff. But if it takes off and you want volume, I'll say, aha. But your supermarkets know better than you do about how much it costs to make your product. They know how much they can squeeze you until you squeak. So when you get to that point, we'll allow you to have more volume, but you're going to have to pay for that. And that was counterintuitive for me when I first heard it. And I realized it's just true that yes, you can have more volume at a supermarket, but you will pay for it.
Are there other paradigms like that you've seen repeat across your investments that you found disproportionately helpful for thinking about opportunities or scaling as a board member?
Most of the things that I've done I've done quite a lot of B2C business models, which are all about customer acquisition. And then perhaps the other thing I realized, and this comes from being an investor and seeing business plans, is when people talk about their marketing budget, they very often say, we intend to spend this much money on acquiring customers. And what I've learned over time is that you should never plan to spend a certain amount of money. What you should have is a target cost of customer acquisition. Now, how much can you afford to spend to get a customer? And just keep on spending until that cost rises. Say, for example, if you think that you're making, say, £20 gross margin on your first order, you can afford to spend up to £20 to acquire that customer and you'll get your money back on the first order. So why would you limit that? As long as you can get your money back or make a little bit of money on your first order, you just keep on throwing money at it until that stops. And so your marketing, so rather than having a budget, we're going to spend £500,000 a year on customer acquisition, say, no, this is our target. These are the parameters. And we will keep on recycling money and throwing it into that for as long as we can. And with Moonpig, we did that. We spent money on TV advertising. We spent the first £50,000 and we had a target cost of customer acquisition of £10. And that money came back quickly enough that we could reinvest it so that we doubled it. We went from 50,000 to 100,000, but we were still getting the same result. So we took that £100,000, that came back and we did £200,000 and then 400, then 800, then 1.2 million. And at 1.2 million, we started to get some resistance on the cost of customer acquisition. So we thought, okay, so we scaled it back to about £800,000 a month. But all of that was customer acquisition funded by our customers because funded from gross margin. So we didn't have We didn't say, oh, we're going to spend £100,000 acquiring customers. We just said, we will spend as much as we can. We can spend as much as we can and recycle it. And that's how we grew so quickly in 2006 to 2007.
I love the way you talk about thinking about allocating that marketing spend. You're obviously very strategic in the way that you do that. When you come to a new business that's looking to scale and hasn't yet fully understood what its growth levers are, what's your approach?
You might as well try all the different channels of channels of customer acquisition with the bare minimum that you need to spend in order to be able to work out what that costs. If you can spend £3,000 with Google Ads to work out what it's costing you to get a customer through Google Ads, that's the answer. And then you try that with every single channel, be that banner advertising, be it affiliate deals, be it television, radio. You try all these different channels and then you put them all into order. And let's go pick off the lowest hanging fruit first. And you keep spending money on that channel, be it Facebook, until the cost of doing that starts to rise. And what you're looking for is scalable opportunities where you can throw money at. PR is one thing, it's worth doing, but you can't. If you spend £30,000 a year on PR, you'll get a certain result. If you spend 300, you are not going to get 10 times that result. It doesn't work that way. Whereas with TV, when we spent £50,000, the next month we spent £100,000, we got exactly the same result, exactly the same cost per customer. And it's a channel that can absorb quite a lot of money. Other channels are a little bit more limited. With paid for search, for example, before, when we were still quite small, when we were entering in the word personalized greeting cards, there weren't many people looking for personalized greeting cards because we were the only people doing it. And if they didn't know that we existed, they didn't know that the product existed. So we maxed out at about £3,000 per month search terms on Google because there's just a limit to the number of people looking for personalized cards back in those days. It's probably very different now. So that's an example of something where there's just a cap on what you can do. And there are also some things that are limited by cost. So if the cost of acquiring through that channel is more than you're recovering in gross margin, well, you can't do it. And I've had to close a couple of businesses where things have changed and the cost of customer acquisition is greater than the gross margin we're making. We can't grow on that basis. Of course, you can throw lots of money at it and grow your revenue. But if you're growing your revenue and you're growing your losses at the same time, you're hiding to nothing. So you've got to be sustainably growing. I think there's a great metric that the VC world use, which is the rule of 40, where you take your sales growth and your EBITDA percentage, and that needs to add up to more than 40. And for you to be a growth business. And that makes a lot of sense because sometimes you can throw a lot of money at growth and still make no money, but your top line is growing. And then that gives you the opportunity later, once you've reached as much as you can grow, you can then take your foot off the pedal and it flows down into profit. But if you're spending £1,000 to get you a customer that makes you £500, and you're losing £500 on every customer, you're just making a bigger and bigger hole.
Yeah, I've definitely seen a number of businesses come a cropper where they've made assumptions the price they're able to acquire customers at today will scale, into over the next 5 years. And of course, as you alluded to there, it dips off. If you've got a finite amount of resource, are there particular channels that you would always guide an organization to testing first because you've seen over time that they are the ones that typically most likely to succeed?
So some of the digital channels can be tested with a relatively small amount of money because they're incredibly traceable. So Facebook advertising is incredibly traceable. All these social media channels are very traceable. So you know exactly where your money's gone. And you can measure the quality of those customers over time. So you can say every Facebook customer did this. This is a typical profile of a Facebook customer. Starting with digital is always much better. When it comes to broadcast media, it's a bit more scattergun. You can measure it very well, but you can't measure it as well as you can digital. And also the starting point is much greater. If you want to try advertising with TV now, to get any kind of meaningful result, you're probably having to put £150,000 in, which is a combination of maybe £50,000 spent on the media itself and £50,000 on the advert, and then £100,000 on the media. So some things are chunkier, but TV is a big pot. You can spend a lot of money on TV. If it works, you can spend quite a lot of money on it. And it's helpful rather than having 1,000 different channels that you've got to monitor each one, having somewhere where you can just put your foot on the gas and go is quite helpful.
I was recently talking or listening to Richard Harpin, the founder of HomeServe, who was talking about his 8 rules for growing a multi-billion-dollar business. And one of them is print, bricks and clicks. You've talked about print and clicks, not so much about bricks. How does that factor into your growth thinking with businesses?
I know by bricks you're referring to online, high street retail.
Yeah, so it's just sort of actual physical present.
I've not really had much to do with physical business until last month, actually, when I opened the South Wilts Ski Club. So I now have it. That's very much bricks and there's footfall. But I've never been involved in high street retail where your rent is effectively part of your marketing. And that's certainly the way that I've always looked at it, is that every time you open a shop, your marketing budget is to some extent you're paying to be in Oxford Street, which has a certain footfall. If you pay a lot less to go down a small back street that nobody goes and walk past, then clearly your business is going to collapse. A lot of that has changed though, because people now customers are very multi-channel. You might want to go into a shop to go and look at something, test it out, see what it feels like, but you don't necessarily want to carry it home. So you'll go to that company's website and order it from their website and it'll be sent to you. So the company is still as well off as if shouldn't make much difference to them whether they sold it online, whether you ordered it online or you bought it, took it away in the shop. But the high street experience is still very important for seeing things. We've all made the mistake of ordering something on Amazon and it turns up and it's this big. You thought it was that big and it's actually this big. And a friend of mine ordered a whole load of what he thought were fire pits, big steel fire pits for his wedding. And about this big. He thought they were about that big. They were ashtrays. Yeah, we've all done it. I think of the amount I kicked myself. There were no measurements online. So
Nick, time has flown, which means it's time for the lightning round, where I'm going to say a short statement and ask you for a quick response if you're ready.
Yeah.
So first up, one I have a feeling you're not going to like, but best book every board member should read and why?
I'm not a great reader of business books, but a tipping point by Malcolm Gladwell is if you want to understand why some things just catch a wave, that's quite important to understand, because it's also quite important to understand that you can't necessarily control when something catches a wave. All these big companies, you can retrospectively say why they were successful. But the truth is, at the time they were founded, when Facebook was founded, I don't think that wasn't part of the plan. I think actually it was really the plan was to put together some software that would enable you to rate the relative attractiveness of your your fellow students. There was no big vision behind that, but he caught a wave and he rode that wave quite well. But so understanding the tipping point when something goes viral is quite important, probably something that applies to quite a lot of businesses.
Boardroom behaviour that irritates you most?
Looking at other emails and other device distraction.
Most valuable board ritual?
Put the devices away.
Favourite quote?
I think Bill Gates says something like, your most unhappy customer is probably your greatest source of learning. Something to that effect. Very true.
Most significant professional insight?
Repeat business. And that's the one thing I learned is the most important thing about marketing is that the best indication about a business is looking for repeat business, because that's the indication that you've got everything right.
Worst professional advice you ever received? I
had a contract. It was an investor had come in and I got an investment agreement. And we'd agreed that the price would change if he said, look, I don't want to be embarrassed if you then raise money at a lower price in the next round. And by the time the lawyers wrote the subsequent round had changed to a subsequent round. The difference being that 5 rounds later or 4 rounds later, we then had a down round. And what that meant was I then had to issue shares from my own holding at the price of that down round. And that wasn't what we intended at all. But it's just the difference between A and the. So that taught me you've really got to read contracts. Lawyers make mistakes.
What have you changed your mind on about boards over time?
I think what I've realized is that all boards, there's no one size fits all for boards. All boards are very different depending on the number of shareholders are around the table. If you have a board where 75% of the shareholding is represented around the table, you don't need to think that much about what would the shareholders think, because they're there. But that's very different from a company where you've only got maybe 20% of the shareholding at the table and someone else has to think about what the other 4 people are thinking about. So it's very different. It's also very different depending on whether or not you've got a founder who still effectively de facto has control. If you're sitting on a board where a founder de facto can do what he wants because he's got more than 51% of the votes in his own pocket, that's very different from being in a situation where you've got a founder who still doing a good job, has only got 10% of the shares and can't throw the weight around in the same way. So that's a very different complexion. Each board has its own complexion, and you can ask for advice about how other similar companies with a similar complexion have done things, but just remember they're all different.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
I probably got lots of things wrong very recently, but the one I can remember some time ago when in a company, we had a business which was very much dependent on a government policy. And when that government policy ended, that particular revenue stream was going to end. So we had to work out what we were going to do beyond that. And we came up with a plan which involved diversifying about 5 different business streams, none of which were really connected. And I think the lesson I learned from that was that when you diversify or come up with it, that is like having 5 startups at the same time. And it was very distracting. And actually, none of them really worked. And that was a huge mistake. I learned a lot from that.
How are you better today as a board member than when you started?
I think I've just seen a lot more. I've sat on probably 15 boards in my time. I've seen what works, what doesn't work. And I also, I think with experience, when to hold your tongue and when you know the limitation of what you can add. It's right to ask questions, but you probably don't have all the answers. The CEO is on top of the detail and will always know more about the business than you will know. So you just accept there are limitations to what you can do, but they shouldn't stop you from asking questions.
Finally, 3 things our listeners should take away from this podcast if they take nothing else.
I think perhaps my one mantra is the importance of repeat business, and how much and what's happening with repeat business is a real metric of the health of a business. That's one. 2, there's no one size fits all to a board. Just understand that your board will have its unique complexion and you need to work out a strategy that works for your board. And I can't think of the third one.
Nick, that has been absolutely incredible. I absolutely love the way you think about these things. Your incredible experience really shines out. Thank you so much for taking the time to share your wisdom and experience.
Thank you. Great to speak to you.
Building a non-exec career is hard. For those starting out, boards can be opaque. For more experienced board members, it can be lonely and hard to stay match fit. Having placed almost 4,000 people on boards in the last 5 years, we know what success looks like. It requires time, energy, resilience, information, and connections. New Role Plus, our community of board peers, exists to give you these things, offering you wholesale support as you try to get board roles and become a standout NED. Find out more at newrole.com/newrole-plus. That's newrole.com/newrole-plus.